Right now, the average American carries 4 credit cards, contributing to a collective national debt that recently surpassed $1 trillion. Yet, at a typical dinner party, the conversation rarely touches on that debt. Instead, people often spend more time discussing the weight of a new metal card or the most efficient way to maximize travel miles. We tend to view these cards as simple tools of convenience, but they occupy a unique space in our spending habits. Despite our best intentions, the behavior they encourage often runs counter to our financial interests, suggesting there is more to the design than a simple plastic utility. To understand exactly how these modern habits formed, we have to look back at the American economy following World War II. Families suddenly had disposable income, and showrooms were overflowing with a new generation of consumer goods. In 1958, Bank of America launched a radical experiment to capture that spending power. They dropped 60,000 unsolicited credit cards directly into the mailboxes of residents in Fresno, California, without asking for permission or conducting a single credit check. This card, the precursor to modern Visa, introduced a concept that changed the marketplace. It allowed a person to walk into a store, take an item home immediately, and defer the actual cost to a later date. This separation of the purchase from the payment effectively neutralized the natural hesitation a consumer feels when parting with their money. Researchers refer to that hesitation as the pain of paying. When you physically hand over a $20 bill, your brain registers a mild neurological discomfort, signaling that you are losing a resource. Swiping or tapping a piece of plastic bypasses this friction. The brain gets the immediate satisfaction of the purchase without the corresponding signal of loss, making the transaction feel consequence-free in the moment. An MIT study demonstrated this effect by tracking bids for sold-out sports tickets. When participants used credit cards, they bid nearly twice as much as those using cash for the exact same seats. The delay in billing further weakens our financial resolve. By the time the statement arrives weeks later, the memory of the purchase has faded, leaving the bill to feel like a disconnected chore rather than the price of a specific reward. The credit card model operates by exploiting this neurological blind spot, shifting the weight of today's choices onto a future self that doesn't yet feel the cost. To keep users engaged, the industry layers on rewards programs, presenting cashback and miles as a way to earn a return on everyday spending. Every swipe requires the merchant to pay a fee, usually 1.5% to 3% to the card network. A portion returns to you as a reward. To maintain margins, merchants raise prices across the board, creating a hidden wealth transfer where cash buyers subsidize credit users. The points system also adds a layer of gamification to routine purchases. By offering bonuses or streaks, the cards turn a simple transaction into a feedback loop that rewards the act of spending itself, independent of the item's actual utility. This drive to level up or collect points often encourages consumers to spend more than they otherwise would, often far exceeding the actual value of the rewards they earn. If that spending results in a carried balance, the math becomes the primary driver of the relationship. A typical $5,000 balance at 24% interest creates a massive long-term hurdle. If a consumer makes only the standard 2% minimum payment, it takes over 20 years to clear that $5,000 debt. The interest alone totals nearly $9,000, transforming a single month of spending into a $14,000 burden. The minimum payment keeps the debt manageable month to month, ensuring that the consumer stays within the system while generating interest long after the original purchase has lost its value. Once a user falls into this cycle, they become a permanent and predictable revenue stream for the card issuer. Staying disciplined is difficult because the system is tailored to encourage swiping at every turn. When every aspect of a card's design, from the rewards to the billing cycle, is refined to influence behavior, falling into debt is a predictable outcome of the engineering involved. Breaking the cycle requires manually reintroducing the friction that the card removed. Before you swipe, pause and say the exact price of the item out loud. Forcing yourself to acknowledge the cost in words can help trigger the financial defenses that a tap-to-pay system silences. It is also helpful to ignore the reward system entirely while carrying a balance. No cashback rate can compete with a 24% interest penalty. The points are only a benefit if the balance is zero. You can also bypass the monthly decision-making process by automating payments at a level significantly higher than the minimum. The credit card industry is built on a deep understanding of human psychology. But that system loses its effectiveness the moment you recognize the rules and choose to stop playing by them.